So we have Sergey and Anna, which are level one students at the Global Forecasting School, and they are responsible for updating every week the market reference scenario on Thursday. So this is, a scenario where we look at the futures market for the Fed funds rate, but we also look at other financial data. In fact, the entire term structure as well as BAA spreads, okay, because we think that is the best financial indicator about whether or not financial markets think that there's a risk on the horizon and so on. But Sergey, can you please explain what it is you do every week, and then take us through what you think the picture, the evolving narratives are about the U.S. economy?
Yeah, sure. Thanks, Doug. So, as Doug mentioned, we do the weekly surveillance of U.S. economy, and there are a couple of steps that we do every week to prepare our analysis, and then obviously publish it at the Better Policy Project website. So, first of all, we obviously every week up to Wednesday look at the US data, whether there are new data incoming, and obviously we incorporate it into our analysis and look at all the important data possible to first of all analyze where is US economy now and what are the underlying forces that drive these current trends. And this obviously helps us with coming up with the narratives of the risk scenarios, and in each case where the US economy could go, what are the risks, and most importantly, that's our usually third question of our framework is what we need to do then obviously with policy instruments, or in case of Fed, how the US monetary policy need to evolve in each case to achieve their primary objectives. And then after we have the narratives, on Thursday, we update the market reference scenario. And market reference scenario in our F plus Mark II framework has a very important role, as it is used as a reference around which we build our case A and B risk scenarios. And basically, market reference scenario is the scenario in which we use the expected path of the Fed funds rate from the options market and build the consistent scenario, macroeconomic scenario using that path. And we obviously apply judgment to think what could be the consistent dynamics for the economic variables with this expected path. And then obviously, given our narratives for case A and B scenarios, we build the case A, which is usually the situation or collection of risks which requires more hawkish stance from the Fed, while in case B it's the opposite. It's the situation that requires more dovish stance from the Fed than what's priced in financial markets. And in case there are some extreme scenarios or risks incoming, tail risks, we also think about case X and Y scenarios to avoid so-called the dark corners, like the high inflation environment or low inflation trap. And these case A and B scenarios are prepared usually on Fridays. And on Thursday, for the market reference scenario on Friday for case A and B, we post it on our Better Policy Project website with the respective video commentary, what we think are the explanations for and the narrative for each scenario. So this is basically the process every week. And now let me dive deeper into this week's concerns and updates, etc. And let me start with the GDP growth and demand side of the economy. Okay, the first, the most important narrative that we have been talking about for already a couple of quarters, if not more, is that the GDP growth in U.S. economy remains robust. and it's mainly one of the main drivers of this growth is consumption, especially in quarter 2, where both the service and goods consumption contributed to this growth. And even if we look at the GDP now, which we think is the one of the best nowcasts, given its methodology, which mirrors the Bureau of Economic Analysis methodology of building GDP, and it helps us to also not only see the number itself, but also look at the detailed subcomponents and come up with the narrative of the incoming nowcast. Okay, and the GDP now currently is estimated to be around 2.5%. It's important to note that since the August, it came down in the beginning of the September because of incoming ISM manufacturing survey data, and it indicated somewhat weaker confidence in the economy. However, after the new incoming data came, especially about employment situation, as well as the wholesale trade lately, we have the following picture. We still expect for now robust economic growth around 2.5%, and one of the main drivers again being the consumption, which is expected to grow at a quite high rate, around 3.5%. And if one also needs to think about how strong is the demand, one can look at the real final sales of domestic products, which is basically a good indicator of the demand. And what we see is that this demand, or its year-over-year growth, remains strong. And according to GDP now, it is expected to be around 2.3% in the third quarter. So just looking at these broad indicators, we can judge that if these trends continue, we could expect strong demand persisting, driven by consumption. And the supporting argument for this, if we look at more detailed data, or if we extend our narrative, is that for after COVID, basically, we have seen the large increase in asset prices. We usually have, we thought about this increase could be partly driven by fundamentals like technological improvement and AI investment. However, given the overly optimistic feelings about from the market participants, investors from this AI investment, there is an asset price bubble, humongous asset price bubble in the stock prices, which could be basically thought about if we look at that the stock prices almost doubled since the onset of this COVID pandemic, which cannot be fully supported by fundamentals, as especially the news come that the gains from AI aren't as pronounced as they were expected in the beginning of this AI boom. One simple maybe indicator why we think stock market is sits on the bubble is that every time some kind of more negative news comes in terms of U.S. economy data and etc., or Fed decisions, the stock prices start to bounce, and this volatility is large. For example, in August, given the unemployment data, the stock prices fell quite significantly, but then afterwards they recovered. So this was kind of negative, temporary negative volatility. And stock market also is uncertain in a sense that this can go in two different ways. One is that this temporary volatility could continue and we could see increasing asset prices in the future, especially if this Fed will start cutting rates and accommodate this asset price bubble. Then these increasing asset prices will further support the net worth of the households, which is a good proxy for the wealth. And this strong wealth, will obviously boost consumption further, and we will have demand pressures persisting, which will translate into persistent inflationary pressures further. On the other hand, we could have the another scenario in which the stock market starts to correct. That means stock prices will start to decline persistently. And in this case, this will obviously have the negative implications for firm profitability. And at the end, we will have the negative implications for the economic activity. That could make us fall more into case B type of environment, where this negative firm performance and weaker activity will support a disinflation process and will weaken demand in the end. Now, this is the more outlook from broader demand side, but I believe it's important to look at the labor market, which showed us or like indicate for the last 2 months, we have been receiving like uncertain signals from the labor market. The unemployment rate, for example, was persistently increasing for past couple of months, and it especially jumped in the July from 2.1 to 4.1 to 4.3%. And obviously, given this large jump, the expectations of the market participants and investors and analysts was tilted more towards the recessionary scenario. This was reflected even in the expected path of the Fed funds rate. However, one needs to dive maybe deeper into these numbers to think whether this is truly indicative of a recessionary scenario or recessionary risks, or it's a slightly different story. And if we look at the labor participation rate, we see it have increased in July, especially to 62%, almost 63%. Now, this means that labor supply increased, and probably the whole labor supply wasn't absorbed by firms right away, and this caused temporary increase in unemployment, especially if we consider the fact that in July we had the temporary layoffs also, connected to different reasons, partially to extreme heat that led firms to increase the temporary layoffs. But these layoffs recovered this month in August, and we have seen the decline in unemployment to 4.2%. So our judgment is that labor market is cooling down. We see some slowdown, especially if we look at the job gains, for example, or for example, the employment. But there is no clear signs of the recession coming. If we look at, for example, the vacancy to unemployment ratio, which is a good indicator of labor market tightness or imbalances between labor demand and supply, it has already fallen below the pre-pandemic level. So basically, our narrative is that the labor market is cooling down. We see the slowdown, and this slowdown will support or will help to weaken the pressures on wages, which is obviously has some part in the persistent inflationary pressures in the services part. For example, if we look at the wages, finally the Atlanta Fed resumed its wage growth tracker after March. And we have like two different measures, average hourly earnings growth as well as wage growth from Atlanta Fed. The common narrative is from this data is that the wage growth is declining. It could be indicative of this cooling down of the labor market, which helps to weaken the pressures on wages, but they still remain elevated below what we think is the consistent level with the 2% inflation target, which is around 3.5% from our judgment. And what it means is that the wages, although weaker and weaker every month, still have some influence, positive influence on inflationary pressures. Obviously, this is evident if we go to and analyze the inflation data. And now Anna can continue
The analysis
the
on
analysis on the inflation.
So
Can
if we look
can
at
I
the inflation, sorry.
Doug, you wanted to say something?
Yeah, can I just respond to the
Yes.
to the wage one? Okay, that you had there. Okay, um, so we always have to think about potential data issues. Okay, so we have this problem in the labor market on the previous slide. Okay, or I think one of the previous slides where you had the unemployment rate and so on. So we see that increase in the unemployment rate, which was say around 3.5 last year, and so on. You can see it kind of stabilized at 3.5, which is a very low number and stuff, and that reflects to a large extent, the market was tight. I mean, there were tons of vacancies for jobs that they couldn't fill, and so a very nice presentation of why it looked like the Fed achieved a soft landing is one of the things that Waller pointed out in his speech on Friday. Anna Heat made a really nice video of it, but the idea is that what Waller thought is you raise interest rates, and what happens is that unemployment doesn't go up because you have all these vacancies. So what happens is it drives the demand for labor down, and so they have less openings and stuff. And of course, that happens first uh, when financial conditions, not monetary conditions like the Fed funds rate, but when financial conditions then start to bite in a way that is suggesting that a recession might be underway, then the reduction in labor demand results in rising unemployment and so on. So this is very important. So obviously, when we look at the vacancy curve, the fact that it's coming down and now is, I guess at pre-COVID levels, we'd say, well, we're through that part of it. Now we might be worried that the unemployment is going up, but there lies the problem that I think we probably need to investigate better. Both Chairman Powell and Waller are not talking about the dramatic difference between employment growth from the population survey, the household survey, and employment from the establishment survey. So on a year-on-year basis, employment from the household survey has basically been flat, which doesn't make any sense. I mean, but that is the employment number, a very weak employment, like almost zero year-on-year growth. That is a number that feeds into the unemployment rate calculation. So this 0.8 percentage point increase in unemployment from 3.5 to 4.3, and then it subsequently declined to 4.2. Those numbers are being calculated with the employment numbers from the household survey that simply don't make any sense. And so the question is, how much are they distorting the unemployment rate? Now, obviously, if the reason was not incorporating immigration into the numbers, then it might be the case that it's not distorting the unemployment rate numbers if it's distorting the labor force numbers in exactly the same way that it's distorting the employment numbers. But this really comes down to a question that we should be able to say something about if we had some idea, for example, about the unemployment rate of the people that are these immigrants. How is it different than the non-immigrant unemployment rate? Because then we could say, well, if we have estimates of immigration of 2 million people, that is able to explain the dramatic difference between employment from the household survey and employment from the establishment survey. So So the gap is about 1.5 percentage points. So establishment survey employment is growing by about 1.5, and so on. So back to your comments now about wages and stuff. So if labor productivity was 1.5, okay, and if labor inputs was 1.5, okay, which is it is in the establishment survey, that'd be consistent with GDP being, about 3%, which is what we think it was. Now the economy is slowing down. One of the indicators that you used that abstracted by changes in inventories, you can see very clearly uh, that it was slowing down in the first half of this year, and so I guess my main point would be that there's more data uncertainty here. People aren't talking about it, but I like these charts because it sort of makes the point that Waller was making, that why has there been a smooth landing? Well, because uh, we had incredible amounts of vacancies because the labor market was really, really tight, and typically we wouldn't have that. It's a really a lot of vacancies, and so we had to kind of go through those first, and before we had an increase in unemployment. But now we're in the second phase, but we got this problem with data. Okay, now back to your hourly earnings on the next page. If you think about that and 1.5% productivity growth, well, that would be consistent. Those data are consistent with 2% inflation, roughly, because if labor productivity growth is 1.5 and you have 3.5% wages, so they're just a tad above what would be consistent with a 2% inflation target. But the problem is that those data have wage shift. This is like hourly earnings that is aggregated over all the firms in the economy. And so if there was changes in the composition, that could affect this number. That's why the number on the right is particularly informative if wage shifts were going on, because if you ask what is the increase in median wages, okay, that tries to abstract from these wage shifts that would affect. Now, in addition to that, the problem with the establishment survey, it has problems too. Big problems, because when things are going on in the economy, that that survey, the population that they're sampling, which is obviously a small subset of the true population of the U.S. economy, if that sample is no longer representative of the true population, then there can be big measurement errors. How big? Massive. So if you actually read the actual employment situation report, they talk about this. And many times when people talk about these payroll numbers, like they're a sure thing and the labor market is cooling, they should really say that when the number is 100,000, what it means statistically is that it could be anything. It could have actually declined, or it could have increased massively. That the survey has problems that are very serious, and it's not just this is not just a problem in the United States. It's a problem everywhere. Anybody that studied these establishment surveys in detail will recognize that it's really costly to develop these good measures of these things. But there does need to be enough discussion about the possible errors in the data. No discussion by Powell in his speech on July 13th at Jackson Hole. And, I haven't seen any governor. Have you heard any governors that are actually talking about this problem? because on social media, like X and so on, people are talking about this just like they're real data, and nobody's distinguishing between the household survey and the establishment survey. Bob Ford, or not Bob Ford, Bob Tetlow from the Fed, and basically, in response to a lot of these threads, basically said, you better check the differences between the two surveys. So the fact that he would say that into a thread, the market is just too concerned about these data without digging into them and truly understanding what the heck is going on. So sorry. Very good. I just wanted to make those remarks. But Anna, you were going to say something.
Yes, yes, I have not also heard any of the governors discussing about that, at least recently, for sure. So let's move on to the inflation. We see that year-over-year sticky price inflation has decreased and is on a has a positive outlook, especially if we look at the 3 month over 3 month sticky price inflation. It has quite measurably decreased. One thing I want to emphasize here is that at Global Forecasting School, we use non-traded sticky price inflation measure in order to understand the story behind price dynamics. And I do believe that as a policymakers, one of the key things for a policymaker is to understand the story behind these price dynamics and what are these underlying forces. And only after understanding that, we can then do the current analysis and use the policy instruments, as Sergey was discussing, correctly to anchor inflation and inflation expectations back to the target. And what we see here, yes, we have some positive outlook. I want to just say something shortly about flexible pricing inflation as well, since we know Fed is using not just the PCE target but also sticky price inflation with the flexible one. If we look at the flexible price inflation, it has a decreasing trend, and if we believe that flexible prices respond to the current economic changes more rapidly than the sticky prices, which we believe are slowly adjusted, and they therefore also include these inflation expectations. If we look at the flexible price inflation, which has a decreasing trend, we do believe that this could be also translated into the sticky price inflation as well. So in that regard, we have some positive outlook, I would say. If we'll move to the July CPI. At Global Forecasting School, what we do is that we just don't do the descriptive data, but we need to understand the CPI decomposition to understand where is the inflation coming from. So here we see that mostly it's in service sector, service inflation being still elevated compared to the goods inflation. And we know that this is sort of a global phenomenon. Like we saw this Isabel Schnabel's speech as well, where she discussed that service inflation being is something a global phenomenon, meaning that it's not just a problem for the ECB or for the Fed, but we see Bank of England and UK very much facing the same problem. So sticky price inflation, especially after the COVID pandemic, when these supply side disruptions started to come across, sort of changed globally, and we still see a 2.8% in June and 2.4% July, meaning that there is a slight decrease. Also for food away from home, there is also a slight decrease in this 3 month over 3 month annualized rate. Yes, but if we move to the here, PCE inflation, which is the main target, inflation target used by Fed, is has changed from 1.2 to 2.4 month over month. However, overall, if we look at the numbers, we can still say that it is somehow going back to the target to 2%. However, stays still elevated at 2.5%. So it's still like that is exactly why we are market watchers. We do this data analysis on first part of the week, and we analyze on Thursdays market reference and scenarios on Fridays, because the data is very challenging, meaning that, for example, if we look at the 3 month over 3 month, we see a decrease in PCE inflation. However, for month over month analyzed, there is still a significant increase between June to July, 1.2 to 2.4. So moving on to the BLT index, something we come across on the left-hand side graph is that bank lending tightness is still more or less easing. However, consumer loans, that's for consumer and mostly real estate loans. However, this C&I loans, which were decreasing quite dramatically, like we see this steep line, they started to sort of have this kink up, and I think it's very interesting to wait for the upcoming data and like in which direction this will proceed. However, overall, bank lending tightness index compared to the previous quarters has significantly decreased, and 7.9% we see on the graph is like very positive outlook for the US. And one thing we should not forget also is that this currently, I think there is some inflation persistence. Inflation perceptions are proving to be more persistent, meaning that we have this called sort of memory cues that make people recall past inflation experiences. And just because we saw a like high inflationary period in the US, we should not forget that there could be some disinflationary risks as well, meaning our case B type of considerations, meaning that there could be also some stagflationary shocks coming into the place. And just because we think about this elevated inflation a lot and case A type of scenario a lot, we should not forget that there is also risk coming towards the case B scenario as well. So, for example, this bank lending tightening index, if this were to decrease even further, that I would say is a type of case B type of considerate risk, because this highly elevated inflationary environment that we had during the past couple of years, and this inflation persistence has increased measurably across advanced economies, including this US. And I think we should not forget that there are risks towards both sides. So if we move on to the next, most importantly, I would like to finish my presentation stating that today is a day for market reference scenario. And if we look at the left-hand side graph, so far we can see that market has revised downwards their expectations quite significantly, meaning that they are expecting for a rate cut in their and there will be a Fed meeting and policy decision in September, we know, and it's very important to analyze the U.S. Current stance before that meeting. That's what exactly we do, me and Sergey, and so this market probability tracker, we see that the expectations has revised downward significantly, I would say. And this could be due to this positive outlook that Sergey has been discussing about the GDP now estimate, as well as the labor market, and from the also from the bank lending tightening index as well. Thank you.
Yeah, I had a few questions, okay, that we can talk about, okay. But if you go back a couple of slides, and so I was struck. No, the one afterwards. I was struck by the slide after this one. So I was really struck by those numbers for services. 2.4, 2.4, 2.4 in May, June, and July. So that kind of struck my eye, and so on. So I think, yeah, sort of acknowledging that this is really, these numbers are kind of amazing. Okay, when you think of kind of like a smooth landing scenario, right? And that's why, even people that are totally skeptical were totally skeptical about the smooth landing scenario, why it's better to have an FPAS Mark II framework, because you don't want to put all your eggs in one basket and stuff. Right now, from the perspective of the market, and almost like the perspective of the Fed, it just looks like all these pieces are falling into place, and that there is a scenario where if the Fed just cuts rates gradually over time, where the economy could be in this kind of wonderful smooth landing. But what seems really weird about that is that it's happening at a time where people are really concerned about risks, all kinds of uncertainty. So I just thought that kind of acknowledging that point in the table. Now, next slide, which is kind of connected to it, because you talk about. Yeah, go ahead.
Yes, just one thing related to that one as well. Can you please stop sharing 1 second? One thing very much also related to that one is, I'm pretty sure you know this one as well, but you see here 5.3, 5.3, 5.3 for this April, sorry, May and June, April, May and June 3. So exactly to that point that you mentioned, the soft landing scenario being just so I would say also like just one of the scenarios, of course, maybe not as much as the Fed expects, and I just wanted to take your attention to
Yeah,
this.
I mean, so it's like you've got some data that are kind of consistent with case A, with the case A narrative, and you've got some data that are consistent with the smooth landing, and you might have some data that's consistent with concerns about something really bad happening. But the only problem is that I don't see any data about concerns about bad stuff happening. Can you go back to the financial conditions part of it? Because the thing that I would like when we look at this, these are new loans, right? I mean, that's what you're plotting here, okay? And so I was really struck by a chart that Lacassie had, where he plotted nominal consumption expenditures, okay? And it was 5%, okay, 5%, right? uh, and that, when you kind of think about, kind of real households and stuff, right? They've got, they've got a whole bunch of money. There's a whole bunch of money in the economy. Okay. Now there's concerns about the lowest income people, and we've seen delinquencies rise like a little bit and stuff like that. And we've seen reports from earnings that some retailers are concerned that they think that market is. But at the same time, we've also seen positive surprises in consumption, aggregate consumption, despite all these stories. So the question is, when we had all this money, okay, all this debt, so again, when you look at it from the perspective of the U.S. household balance sheet, both the asset and the liability side has increased a lot. The liability side has kind of kept up with disposable income, uh, and so on, right? So you can see, net worth, as a share. So obviously, if you look at assets and you look at liabilities, inside the liabilities are mainly going to be the stock of mortgage loans and the stock of credit, right? And so when you think about consumption from the perspective of Merriam's consumption function that has disposable income and net wealth, okay, we don't seem to be at the point, but where you would say that the economy doesn't seem to have enough money. It has a lot of money because these equity prices that we're observing, people have to use money to buy that stuff, and they can switch to buying that stuff or buying consumption goods, and their 5% consumption is just kind of, I think it's just an interesting way, kind of like a very common sense way of looking at it, that people have budgets and they say 5%, which has been that chart. I think it's really cool. Now when you look um, at loans, new loans, and so on, okay, the only thing in your picture, for example, when I was looking at that picture, you look at, for example, mortgage loans. Okay, not this picture, but the one where you're looking at, I think, at new loans and looking at mortgages and so on. So it's not on this slide. It's on a different slide. Okay, where you had also the bank lending tightening variable. Okay, this one. And so you see that, obviously it's slowing down. Thank God. Thank God. Thank God. If it wasn't slowing down. But the thing is that if you just look at it and say, oh, it's slowing down, without realizing that its level is pretty high. Okay. So I think that, you need to look at that green line, for example, and say, geez, look at the value before COVID. Look at the value from 2017 to 2019. It's not much different than what it is now. So when the economy has lots of money, okay, because of increases in debt and stuff, in this case, government debt was a big part of it. That money ends up circulating through the economy and supporting asset prices and prices of consumption goods and people's real consumption plans and so on. As for the chart on the right, conceptually, it is the change in credit standards that is going into that thing, and the issue there, and the reason why I would discount that chart as an indicator that a recession is about to happen is that there should be arbitrage. So if those, credit standards are tight, okay, when we think of like a bank deciding in its portfolio, does it want to have so much loans, so much government securities, for the loans, what kind of riskiness is it prepared to accept? And obviously that will depend on whether or not the bank think that a recession might be around the corner. And so if that were the case, okay, then there should be some sort of arbitrage, not just in rates of return, but in rates of return of assessing the risks of a recession. And that I would look at the B double A spread, because that BAA spread is still below 2. Okay, so put another way is that when you're looking at that bank lending tightening variable, it'd be really good to compare it to the BAA spread. Okay, because BAA spread is something that you can observe every day, and conceptually it should have the information, or there should be some information in it about whether or not people that are engaging in financial markets, do they think a recession? And I would say no. And so therefore, what I would do, given that I don't have a level of financial conditions from the senior loan officer survey, I would try to think of those two variables as trying to maybe tease out what you truly think the level of financial conditions are. And I would only add one last final point. The S&P is up again to 5,500, which is precisely an estimate that I referred to in a video a few weeks ago. And so it's not quite up to its peak, but it is way ahead of I think what anybody would think. And if there is an increase in interest rates, like if it does turn out to be the case that case B is more likely that service price inflation is more persistent than what we think. Okay, so Isabel Schnabel has been talking about this, and we agree with her that this is a real concern. And maybe the US is different. Okay, like long-term inflation expectations have been very anchored in the United States, far better anchored than in the Euro area in the United Kingdom. And there's good reasons for that, because historically the Fed has done a better job keeping inflation closer to the target on average, and so on, right? So I think that there's some interesting work that we can do. Not this week. This looks good, like perfect for me. And I think we just carry on what we're doing, and I think I'm happy to get this out the way it is. I mean, if you guys are okay with that, but
Okay.
okay. Now, Sergey, maybe just give a brief kind of wrap up, like kind of summary of and these modifications we can do. Okay. Can you give a quick summary of what you've taken away from these discussions?
Yeah. So just to summarize, obviously we had a very comprehensive discussion for like last hour, I believe, and let me summarize this in our traditional way in case A and B type of risks. Okay. So given our discussion, I believe in case A type of risks, we have the risk of strong demand persisting again through this growth in asset prices supporting consumption through wealth. Okay, and additionally, we have this risk of wage growth, even though the direction we believe it's towards again cooling down and exerting less and less pressures on inflation. But currently, the wages and together with the sticky prices, they form a kind of picture where we could think the wage, this inflationary premium is still there in this wage price setting behavior. And this is obviously the risk for the inflation, upside risk. So in case A type of scenario, again, we have this assumption of this inflationary risks persisting in the future. And we should not forget the assumption and what we believe that neutral rate could be higher in case A type of environment. Here we agree, for example, with the Larry Summers arguments in terms of the robust performance of US economy despite tightening of monetary policy could be one of the indicators that the neutral rate is higher in the economy around force. That's our assumption in our case A. And plus, we should not forget also about the fiscal sustainability issues, the debt dynamics, which according to CBO's projections could increase in the future. Okay, and this could really affect the term premium, like increase in term premium. And we could, given all these arguments, we can assume in our case A scenario that neutral rate is higher. And all these assumptions would obviously, in this scenario, would be indicative of Fed to have the tighter policy or higher interest rate path than what's in the financial markets for now. And let me also summarize other risks under case B type of environment, because given the asset price bubble that we argued for in the stock market, if the stock market starts to correct, and it will imply the negative implications for firms in terms of profitability and in the end the activity. This together with the labor market cooling down, exerting less pressures on wages and consequently less pressures on inflation, these two will act as a disinflationary force, will accelerate in this scenario the disinflation. And obviously in this scenario then Fed will need to have the lower interest rate path or lower policy path than what's currently in the financial markets. So this is basically the narrative for the case A and B scenarios that we can take from our discussion, I believe. So I'm open to comments also and suggestions, but
I want
this
to
is
ask.
the summary I wanted to give.
Yeah. No, I just want to switch and ask kind of like a more general question and so on. So at the seminar yesterday, okay, we basically asked the question, looking at Isabel Schnabel's speech, where she was talking about things that looked like that would fit into FS Mark II. In fact, FS Mark II we think would be perfect for the things that she's concerned about, but it would require like a big investment at the ECB. And so we asked you guys, the students, whether or not they should jump straight to FPAS Mark II, or whether or not they should transition through FPAS Mark I. Okay, and basically everybody, I mean, just we've been doing FPAS Mark II. Just the idea that you come up with A and B, and then the markets just start kind of bouncing back and forth. The idea that you don't have to fundamentally change your narrative every day. That every day the probability of a case A type of scenario versus a case B type of scenario changes, and you're fleshing out, making various assumptions and hypotheses about things. And as new data comes in, it just makes our job easier. Now, Anna, the one that she's in charge of anti-group think. We've given her a new job because we believe very much in anti-harebrain. And a part of anti-harebrain is making sure that we don't suffer from group think. So she raised, I think, like an important point. Actually, she made a couple of, I think, really important points. But one point is that, and this is a good question for you, Sergey. Okay, one point is can you really truly understand why you need to do FPAS Mark II without going through the process of doing FPAS Mark I? And I mean, it's not exactly the same thing, but the fact that you create a market reference scenario, that's a little bit like, in fact, when you look at the ECB, right, what they do is they ask, here's the forecast of the interest rates. That's what you're doing, except they lock it in weeks before because their process takes a long time to produce. You lock it in yesterday or today, I guess. Okay. So there's that fundamental difference. But the second thing is that you're asking a different question rather than take that just as an assumption. You're asking, what would a consistent macroeconomic scenario that looks at all available information, what would be consistent? What would be a story, a narrative that would be consistent with that market? That's not exactly the same thing that the ECB does, but it's better. It's much better, right? Because from a policymaker, that effectively is what they should be asking when they're creating these baseline scenarios, is not to try to put the policy in that line, because that's folly. Okay. Like if you have a system where you try to put the policy in that line, and if it's, for example, infeasible to do that because something happens and you don't have time to put the policy into the baseline to get everybody, to agree. So if you sort of accept that, okay, you have a little bit of a comeback, I think, to Anna, right? In the sense that you're saying, well, we're doing things that are that in some sense will deal with the things that people that were doing FPAS Mark I, and when they told us you're getting rid of the baseline, we have something that's maybe better than the baseline, in the sense that it could be used as a reference point that policymakers could talk about. And this would handle Anna's point in the sense that there could be accountability for the construction of this market reference scenario, right? So this is to deal with Anna's second major point, which is an FPAS Mark II scenario could be problematic because if the people were doing it in a way where they were just using it as a way to obfuscate and come up with all these scenarios, basically, to justify crazy policies, that they're truly not committed to the spirit of not just FS Mark II, but the kind of spirit of transparent monetary policy frameworks. But then Anna then says, but this also, and this is another good point, also depends on the degree of economic and financial literacy, because you have to communicate it to people. So thank you, Anna, but Sergey, what are your views on that? Those kinds of issues.
Like just one little thing I will add. You mentioned something about the like a new data comes in and then you have to change this. How I look at the FPAS Mark II is that yes, data is of course important for any economist. However, we have a story, and data is sort of just to support our story. And the story is not changed like as much or dramatically. Like if we think about the consumption story, for example, it's just a story that's more important under FPAS Mark II. And yes, data is also important, of course. However, it's just to support mostly the story.